Hello, everyone, and thank you for joining us. My name is Claire Spinks, and I am Head of Tax Technical and Development for the FRI Group. A little bit later on, my colleague Peter Webb, Head of Advisory for the FRI Group, is going to be joining us as well. So before we begin and get into topic, just a little bit of housekeeping. If you would like to do so, you can request the slides after the presentation. If you do have any questions throughout, I would encourage you to pop those in the Q&A box at the bottom of your screen, and we will do our very best to answer these when the session has finished. We do ask that you do not take any action on the basis of this webinar alone. Inheritance tax is, of course, a very complicated subject, and it's very important that you receive tailored advice, which may, of course, require consideration of another jurisdiction. So UK inheritance tax in the family home. And why might we be concerned about that subject? And perhaps that's because of the level of liability a family home can create in terms of inheritance tax. Family homes tend to be valuable, perhaps one's most valuable asset. And if that's not financially, because the emotional bond that most of us have to our property, it also can appreciate quite rapidly. So because of those reasons, it can be one of the most difficult assets to plan with. Since 2010, we've actually seen an increase in the 74% of the value of a property in the UK, bringing more people into the inheritance tax net. Whilst the nil rate band over that same period has remained at £325,000 for an individual, equating to £650,000 for a married person or someone in the civil partnership. So around 2015, Mr. Osborne made a very bold statement that we will take the family home out of inheritance tax for all but the richest. And following that, we saw the introduction of the residence nil rate band, that sort of headlined £1 million of allowances. But as you'll see a little bit later on, that does not apply to all. And actually those allowances since the introduction have also remained the same. And it's perhaps those stagnant allowances that have led to an increase in inheritance tax receipts for HMRC. So in the year to 31st of March 2023, we actually saw an increase of 17.1% in IHT receipts, up to £7.1 billion. So looking at our agenda then for today, just on screen now. But before we get into the detail, we just want to ask you a little question. And that is, what is the average value of a home in the UK? So the possible answers should appear on your screen now. Just give you a minute or so to answer. We've got 276,000, 286,000 or 296,000. Just give you a few more seconds. Okay, and perhaps we'll leave that now there. We'll close that now. So the answer is actually 286,000. Yeah, and a fair few percentage of you got that right. Great. So moving on then and looking at sort of our introduction of inheritance tax. So firstly, what is inheritance tax? And that, I suppose, is commonly known to be the tax that an individual is going to pay on their estate once they've died. Some see it as quite a punitive and controversial tax, possibly taxing wealth that has already been taxed in an individual's lifetime. So if someone has worked during their lifetime, that might be earnings that are going to have been subject to income tax and national insurance. If they've invested, again, income tax and possibly capital gains tax, and then inheritance tax on death. It's also seen as some to be a voluntary tax because actually really effective planning can reduce an inheritance tax burden. So when is inheritance tax charged? With just two main events. So that might be a chargeable lifetime tax if someone was to settle into trust, most commonly, or again, inheritance tax on their death. Who pays the tax? So generally that's going to be paid by the person that is administering your estate, so commonly your executors, and that's going to be settled from the value of your estate. But if you have gifted to an individual or a trust in the 7 years before your death and tax becomes due because of your death, then that tax is actually going to be payable by those individuals or those trustees. So finally, what are the rates of inheritance tax? Of course, our headline rate is 40%, but actually there are reliefs available that could see the IHT rate to be 0%. 20% is the rate that we will see when things are settled into trust during a lifetime and survive 7 years, and 36% the amount that you will suffer if you give to charity, or if enough of your estate is given to charity. So with all those variables, it's really important that we sort of look and understand what an individual's inheritance tax exposure is likely to be. And when doing so, the first thing that we're going to look at is what an individual's domicile position is. And that's really important to note, that domicile is not the same as residence. Residence can be assessed each year, and really it's really quite definitive in the UK as to what someone's residency position is going to be. Whereas domicile is much harder to determine, and possibly is going to be determined over an individual's lifetime. Now, if you were born in the UK, your parents were born in the UK, perhaps you've remained, it's really likely that you're going to be UK domiciled. If you were born outside of the UK, your parents were born in the same jurisdiction outside the UK, perhaps again you've remained, it's really likely that you're not going to be UK domiciled. But if your position sort of doesn't fall within those two sort of polar opposites, then advice is going to be needed. And why is it? Why are we concerned about what an individual's domicile would be? And that's because it really decides the sort of the impact from an inheritance tax position. As a UK domiciled individual, we're looking at your worldwide estate being subject to inheritance tax. Whereas a non-UK domiciled individual, it is those UK assets only. So everything outside of the UK is also going to fall outside of the estate. Now, often when we highlight that really favourable difference, we get asked the question, can a UK domiciled become non-UK domiciled? And absolutely, that is the case. Advice is going to be needed around that. And it's really important as well that you understand that that may come under scrutiny from HMRC. And that perhaps is best demonstrated with a case of the late British financier Sir Charles Claw, who Sir Charles retired to Monaco for tax reasons, and HMRC investigated his non-UK domicile claim after his death. And Sir Charles had made it really clear to friends and family during his lifetime that he was not happy in Monaco. He spent a lot of his time in Paris, and he sort of publicly longed to return to the UK. Now, after his death, friends and family were actually called as witnesses for HMRC, and that longing to return to the UK proved fatal in his claim of being non-UK domiciled. So now we understand a little bit more about inheritance tax. I'm going to pass over to Peter, who's going to look at methods of reducing that liability.
Thank you, Claire. So how can you reduce that possible 40% inheritance tax charge? Over the next few slides, we're going to consider some of the perhaps simpler ways you can reduce that 40% tax bill. And then we're going to specifically consider strategies for reducing inheritance tax on your family home. Okay, steps to reduce your inheritance tax bill. So let's have a look at some of these. Spend your kids' inheritance, SKI. So we call this going skiing for short. And anything you spend down through your lifetime, of course, is not going to end up in the hands of HM Revenue and Customs. Gifting. This is going to be one of the key strategies that you may use to reduce a possible inheritance tax bill. So gifting, gifts in life to intended beneficiaries. We're going to talk about that in a little bit. Gifts into trust. And one of my favourites, regular recorded gifts out of your genuinely spare income. These are all effective strategies for reducing your inheritance tax liability. Other things you can do, insurance. You can use insurance to fund a possible inheritance tax bill as well. That can be part of your plan. And there are some investments that you can make that can reduce the inheritance tax bill as well. Some investments that you make are actually exempt from inheritance tax. So perhaps we just pause and look at one or two of those with you. So we have this thing called business relief. Business relief is generally available for perhaps the value of a qualifying trading business, or an interest in a qualifying trading business, or shares in an unlisted qualifying company, perhaps a trading company, including a small shareholding. That it could be quite a small shareholding that you have that would qualify. I think more commonly, shares in a qualifying company listed on the alternative investment market, on the AIM market of the London Stock Exchange. Some of those shares are going to qualify for you. Business relief qualifying investments that are exempt just after 2 years of holding the investment. Other assets that you can invest in that come with an inheritance tax advantage, there's this thing called agricultural property relief. And that relief is available on land occupied for the purposes of agriculture, together with appropriate buildings and farmhouses used in conjunction with that agricultural land. Another investment that you might make, which is going to help you with inheritance tax, are UK pensions. And actually, there are some overseas, some non-UK pensions that if they qualify for certain rules, they can be exempt from inheritance tax as well while it's invested in the pension. So these pensions possibly can be passed on to your intended beneficiaries free of inheritance tax when you pass away. This is because, unlike other investments that you may have, your pension isn't generally part of your taxable estate. Now, there is a level of complication here. The rules for your beneficiaries being able to access your pension fund after you've passed on, they're a little bit complex, and you're going to need to want to take some really specific advice for that. Okay. Gifts in life to other people. I like a simple plan, and making a direct gift to your intended beneficiaries during your lifetime is a straightforward and simple plan. It's one of the most effective ways to reduce that inheritance tax bill for you. Generally, as long as you survive 7 years from making that gift, the value of what you've gifted will not be included when we calculate how much inheritance tax you need to pay. And if you've survived more than 3 years from making that gift, then the rate of inheritance tax tapers down from 40% and gets lower and lower until after you've survived more than 7 years, it's then down to nil. But there are some conditions that you need to comply with to make this an effective strategy. So you can't retain any real benefit in the asset that you've gifted, and that could be important for you. You lose control of the asset that you've gifted. It's a gift with no strings attached. And when you make the gift, you need to understand whether or not there's a tax cost for making that gift. Is there a capital gains tax liability because you've disposed of something? And that's really important to understand because, of course, you're making a gift. You're not getting any money in return. So if there is going to be a capital gains tax bill, you need to know that you've got the money to pay that. Another consideration is it's the recipient of the gift who's generally going to be liable to pay the inheritance tax if you don't actually make it to 7 years. If there is a liability there, it's the recipient of the gift who is in the first case liable to pay the tax. Just as an aside at this point, what I would suggest actually, if there are some concerns there that do alarm you, then you might want to consider gifting into a trust instead of directly to a child. And you may be able to solve some of these downsides. So for example, it may allow you to have more control over the asset that you've gifted, even though after 7 years, it should be outside of your estate. So at this point, I'm going to mention gifts to your spouse. So I think in most cases, when we look at a couple, generally assets are going to pass between you, perhaps in the first instance. Now, if you share the same domicile status as your spouse, and Claire mentioned how complicated that can be, any gifts made between you, both in life and on death, are exempt from inheritance tax. However, and it's really quite a big however, if one of you is UK domiciled and you pass assets to a spouse who is not UK domiciled, the lifetime exemption for gifting to that non-domiciled spouse is just limited to £325,000. Now, you can gift more than £325,000, but then you're in the realm of needing to make sure some conditions have been met in order for inheritance tax exemption to then apply. A further £325,000 exemption is available on death for a UK domicile passing assets to a non-UK domiciled spouse. But be aware that if you're doing that, then it could be the case that through life and on death, there's £650,000 that passes to your non-domiciled spouse, but 40% is charged on everything above that. So what can you do? Well, there is a little bit of help here. So your non-UK domiciled spouse can actually elect to be UK domiciled for the purposes of inheritance tax only. And what does this mean? So what it means is that rather than just be limited to £650,000 of assets which pass free of inheritance tax, all assets can pass to the non-UK domiciled spouse who's elected to be UK domiciled completely free of inheritance tax. So that's well worth considering if that's the situation you find yourself in. But it's this election to be UK domiciled is very much a double-edged sword. The upside is that it allows the surviving spouse to receive all assets free of inheritance tax. The big downside is that that surviving spouse now has all of the assets and they've elected to be UK domiciled. So all of those assets are now within the reach of HM revenue and that 40% UK inheritance tax charge. The election is irrevocable, but it lapses after you've been continuously non-UK tax resident for more than 4 UK tax years. So that election to be UK domiciled could fall away after 4 UK tax years of non-UK tax residence, and that non-domicile status would then reassert itself again. And I think the other thing to mention about this election is you don't actually have to be UK tax resident to make the election. So it could be this case that you're living overseas. You can still make this election to help you with inheritance tax. The nil rate band. The nil rate band is generally the amount that can be passed that is exempted from inheritance tax. Currently, £325,000, has been £325,000 since 2009-10. If you share the same domicile status as your spouse, or if you are a non-UK domicile passing assets to a UK domicile, all assets passing between you are going to be free of inheritance tax. No inheritance tax is charged. It's when the second spouse dies that they can benefit from their own nil rate band. And if their spouse hasn't used their nil rate band, they get that nil rate band as well. So when that second spouse passes on, it could be the case that with 2 nil rate bands, they're able to leave, say, £650,000 free of inheritance tax to the next generation, but charged at 40% on everything above that, possibly. So that could be quite a significant liability. There is also a residence nil rate band, and we're going to talk about that in a little bit more detail, but that's supported by the value of your home that is passed on to your direct lineal descendants. So there's an extra amount that you may be able to benefit from, which is exempt from inheritance tax. a bit of a whistle-stop tour through some of the really basic ideas around reducing inheritance tax for you. So what we're going to do now is specifically focus on reducing inheritance tax on your family home. Do we have any ideas for how we can help you with this? There are a few things that we can consider for you. So with inheritance tax allowances set to be frozen until 2028, and inflation at its highest for many years. Actually, I've just seen a news story in the last few minutes that inflation is coming down a little bit now, so maybe that's some good news. We can expect to see even more estates pulled into paying inheritance tax. It's only about 1 in 20 estates at the moment that are liable to pay inheritance tax. I think it's pretty much inevitable that the number of estates that are going to pay inheritance tax will increase. Your most valuable asset in your chargeable estate may well be that family home. And the increasing value of your family home is likely to be one of the key drivers with your increasing inheritance tax liability, given the frozen nil rate band allowances. So just to pick up a couple of numbers on this slide, I've been playing around with numbers as I prepared this. If the inheritance tax-free allowance had arisen at the same rate as house prices, that inheritance tax nil rate band, £325,000, would now be worth £565,000. I think that's quite a powerful illustration of the effect of freezing rates and allowances, how it gets you to pay more tax in quite a stealthy way. For many planning techniques, particularly around your home, there can be a 7-year timeline to reduce your inheritance tax bill. So it's sensible to try and work out if you face an inheritance tax bill sooner rather than later, in case you do need to take some steps to reduce that possible inheritance tax liability. I think this is one of the commonest ideas that people come to me with in terms of reducing inheritance tax. They say, Peter, what about if we gift the home to our children? Will that help to reduce our inheritance tax bill? It's a very, very common strategy. This can be an effective strategy, but there is a lot of advice you're going to need. I'm just going to pick up on a few bits and pieces around this. So the first consideration for me, being the taxman, is there going to be any capital gains tax bill if you gift a property to your children? If you've always lived in the property as your home and there's nothing unusual about the property, so for example, there aren't outbuildings or a paddock or fields that go with it, it's very likely that the disposal, the gift of that property to your children is not going to incur a capital gains tax charge. However, if you've been absent from the property, so maybe you haven't always lived in it as your home, maybe you've used part of it for a business purpose, maybe there's a paddock that goes with it, then you're going to need to take some advice to understand what the possible capital gains tax bill may be for you gifting the property to your children. And bear in mind, with UK residential property, you've only got 60 days to tell HM you've gifted the property or disposed of it, and you've only got that same 60-day reporting window. You need to pay the capital gains tax due as well. And as I said earlier, with a gift, you're likely not to get anything in return. So if there's capital gains tax to pay, if there's money to pay, you need to make sure you've got the funds available to pay within 60 days of making the gift. Secondly, it's got to be an outright gift for this strategy to work. And you must not retain any beneficial interest in that family home. I think the headline here is that this is going to entail you paying a regularly reviewed market rent for the privilege of living in what used to be your family home. So I don't know how palatable that'll be for you. So you need to survive 7 years from the date of the gift. for that value of the property not to be included in your inheritance tax estate. So that's 7-year timeline winding down for you as well. So you're paying rental income to your children. That rental income will be taxable income for your children, depending on their circumstances and the other income sources that they actually have. And if they don't already complete tax returns, they're likely to need to complete tax returns to show the rental income that they're receiving from you. Another consequence for your children being gifted the property is that they'll no longer be able to claim first-time buyer's relief for stamp duty land tax. When, if they don't already own a property, maybe they consider buying their first property. If you've gifted a property to them, they can't get that relief. And in fact, it could well be the case that they're going to pay additional dwelling surcharges when they purchase their own home as well. So there's an impact for stamp duty land tax too for your children for this strategy. I think finally on this slide, and most importantly, is you no longer have control over your home. Now, you may feel that there's very little danger that your children would sell your property out from under you. Well, of course, I'm sure they're not going to do that. But to take a real life example I've seen in my own experience is, what if the child divorces? Will your home, which you've gifted to that child, form part of the assets that are then considered in a divorce settlement? And will your family home have to be sold to fund that divorce settlement for the departing spouse? And just a few days ago in the Daily Mail, there was a very big headline, a very sad story about a mother and a daughter. And the mother had gifted a property to a child for exactly this purpose, to reduce inheritance tax. And then the mother and daughter actually fell out. It was a very sad circumstance. And the daughter kicked her mother out of the home. She got her evicted. So a completely unintended consequence of making this gift to try and save inheritance tax. Are there other options? Yes, there are some other options that we can consider. So what else can you do to protect the value of your home from inheritance tax? You could gift a share of the property that you live in to a child, and you could continue to live in the property as long as the child resides in the property with you. And this is because there is a very specific inheritance tax relief that applies where you give away a share of your home and you jointly occupy the home with the child you've gifted your share of the property to. Now, this could be quite a specific circumstance. It's not going to work for very many people, but if it does work for you, this is a very valuable inheritance tax relief you could benefit from. There are some very specific conditions that you need to comply with to make this strategy work. Just to mention one of those, it's really important that the child only pays their fair share of the bills, or actually perhaps a little bit less than that. And that is because you don't want to be seen as the parent as retaining any kind of beneficial interest in what has been given to the child. So you're going to need to take some really specific advice, but if you feel this might be your circumstance, it's well worth exploring whether this option could work for you. Another thing to consider is, could you insure against an inheritance tax bill on the family home? Yes, you could. It is possible to take out an insurance policy that will pay out on death, perhaps to pay that inheritance tax bill. You're going to need to speak to a financial planner to understand about insurance and to understand whether or not this is a cost-effective option for you. I'll say this as politely as I can. Such insurance premiums tend to increase the closer you get to the point where IHT will be payable, if you understand what I'm saying there. Another thing to consider is, are you making full use of your available residence nil rate band? Now, gifts to direct lineal descendants can benefit from an additional nil rate band of up to £175,000. But this additional allowance is only available for the value of a property which has at some point been your private residence, your main home. If the death estate exceeds £2 million, for every £2 above that £2 million threshold, this £175,000 allowance gets reduced by £1. The residence nil rate band, combined with the £325,000 nil rate band, means that a couple could possibly pass on perhaps £1 million of assets to the next generation without paying inheritance tax. So make sure, if you've got that residence nil rate band available to you, that you factor that in to your inheritance tax plan. For a married couple or civil partners, it could be an extra £350,000 of inheritance tax exemption for you. What else can you do? Okay, I smile at this one because there's a question I'm often asked. Could you gift a property into trust during your lifetime? A UK property, for example. It's a problem. It may work, but you're going to need to consider this very, very carefully. Gifting into a trust during your lifetime with a property, it could trigger an instant 20% inheritance tax charge. We'll call it could be a chargeable lifetime transfer. That's going to depend on circumstances and the value of the property. If there's any rental income being generated from that property, that's going to be taxed in the first instance at the trust tax rate of 45%. If it's passed out to beneficiaries, then they can get credit for that 45% tax paid, but in the first instance, the trust pays 45%. Is there capital gains tax to gift the property into the trust? Well, there are ways to manage that. So speak to a professional. There can be ways that if it's your main residence, for example, there may not be tax to pay, or the tax could be deferred. Thinking about inheritance tax again, there are 10 yearly inheritance tax charges that crop up for the trust. There's an inheritance tax exit charge when the property is passed out, perhaps to the next generation for the trust. In addition, the property in the trust is not likely to qualify for main residence relief, that really valuable capital gains tax main residence relief. There's no capital gains tax uplift on death for a property held in trust. Now, if that property was held in your estate and you pass away, it's formed part of your estate, there's an automatic uplift for capital gains tax purposes to the value at the time you pass on, which could help the next generation. It's not going to happen if that property is in the trust. We talked about this potential extra £350,000 that's available for this residence nil rate band, but that only applies on death. It doesn't apply on a lifetime transfer into a trust. So you lose that potential extra exemption of that residence nil rate band for gifting into trust. A trust possibly could work. In my more than 28 years of doing this, I've seen it work very seldom, to be fair, but it's something to consider. Ask me the question and we'll talk it through with you. Other strategies: downsizing and gifting the excess proceeds from the sale of the property to children, or investing the proceeds inheritance tax efficiently. Bear in mind that you need to survive 7 years from making an outright gift to your children, and no real reservation of benefit generally. And if you're investing inheritance tax efficiently, generally there's a 2-year timeline to get that inheritance tax efficiency for you. So downsizing and gifting, simple strategy, may not be ideal because you're going to lose that family home, but we get it, the bricks and mortar, there's far more of an emotional attachment to that. Mortgaging your home. It's possible to borrow money with a debt secured on your home and give that money away, perhaps to your children. If you survive the gift by 7 years, the debt remains allowable for inheritance tax purposes, and the borrowed money given away will fall out of your inheritance tax calculation. Bear in mind, it has to be a gift. You can't invest tax efficiently for this strategy with a mortgage or a lifetime equity release taken in your property. You're going to have to gift the money away rather than try and invest it cleverly for inheritance tax purposes. Now, parents with valuable property, you could take out a lifetime mortgage or an equity release to realise a cash lump sum from the property and then gift the cash to children or grandchildren. But do the maths on this. The compounding of interest on, say, an equity release loan will substantially reduce the overall saving. And if you die within 7 years of making that equity release and that gifting away, well, the value given is retrospectively charged to inheritance tax, and there may be no saving at all. But say you do this at the age of 60, maybe you live to 95. Are 35 years of compounded interest on that loan going to outweigh the inheritance tax that you're going to save by doing that? It's worth crunching the numbers on that. Okay, and at this point, I'm going to hand back to Claire, and Claire's going to wrap up for us and is going to host our question and answer session.
Thanks, Peter. Yeah, so as Peter was saying, sort of our webinar session sort of ends here, as opposed to just the questions and answers. If I had to sort of summarise what my key takeaways would be from today, I think the first and most valuable thing for anyone is, if you have a concern, is really understanding what your inheritance liability is likely to be. From there, it's really, we can start to look at planning for you. And there might be really simple actions you can take to reduce that inheritance tax liability. You know, as Peter said in his section of the webinar, there are simple sort of planning that we can do. But for a lot of those, it's really important that we do not leave things too late, take action. Potentially exempt transfers in the 7 years are generally going to be quite key to that. And the last thing really is to always speak to professionals and get the advice that you need from a credible source. So I think we'll move on to questions now, and we've had a lot as we've run through some really, really good ones that I think illustrate the points that we've been looking at. So the first, Peter, if the UK property was bought 15 years ago, purely as an investment property and has only been rented out, does this in any way mitigate inheritance tax?
Absolutely not. If it's a UK property, whatever your domicile status, it is within the charge to UK inheritance tax, and there's simply no relief at all for the fact that you've let it out. So 40% of the value of that property is going to be charged to UK inheritance tax, depending on what other assets you actually have in your estate. Simple one to start with, Claire.
Yeah, absolutely. And another one similar, are other assets acquired abroad taken into account when considering inheritance tax?
Oh, now this is a great question, a question we're asked very, very regularly, almost on a daily basis. So this comes down to your domicile status. Remember that a UK domicile, your worldwide assets anywhere in the world, are within the reach of that 40% UK inheritance tax charge and will be included in your chargeable estate when you pass on. We have many clients who've been overseas for decades, but they still remain UK domiciled. Just because you've been outside of the UK for many years doesn't mean to say that you're still not UK domiciled. So do take advice if you feel that you may have displaced, which is the right word, your UK domicile of origin with a domicile of choice overseas. I think the other thing to say, though, that if you're genuinely a non-UK domicile, your exposure to UK inheritance tax is limited to UK assets only. So if you do have overseas assets and you are that non-UK domiciled person, those overseas assets are not within the charge of UK inheritance tax. When you think about overseas assets as a general comment, I would say always consider and think about, are there estate, gift and inheritance taxes in any other relevant jurisdiction for you where you may hold those assets? Anything you would add to all of that, Claire?
No, nothing at all, Peter. think you summarised that well. So looking again to, I suppose, a really common situation actually that we see. So my partner and I live in a bungalow in my name. In my will, I have expressed a clear wish that my partner should live out her life in that home should I die first. The bungalow will then pass 50-50 to my children. My children will likely have a large potential IHT bill to pay, and there's unlikely to be sufficient cash or investments to cover this. But selling the bungalow would solve the problem. With my children being unlikely to cover the inheritance tax bill, obviously during my partner's lifetime, what can I do?
Okay, all right. So, that is a bit awkward. I'm going to start with just a general comment that if you were married, because you mentioned the word partner, if you're married or you're in a civil partnership, inheritance tax becomes an awful lot easier to manage. Probably best illustrated with what's going to happen. So I'm assuming that you're not married and you're not in a civil partnership. This is how it's going to work. So you leave your bungalow to your partner. £325,000 is going to pass free of inheritance tax. Your estate is going to pay 40% on everything else. Your partner, you can manage this. They can have what is called an interest in possession for the bungalow. And what that means is they're allowed to live in it through their life. They're not allowed to sell it. And when they pass on, the bungalow is indeed passed to children. And when your partner passes on, they're able to pass on £325,000 free of inheritance tax to the children, perhaps with £175,000, which is free of inheritance tax, if the property supports that and it's going to directly in your descendants for that partner. What would happen if you were married or in a civil partnership? So you pass the bungalow to your spouse or civil partner. There's no inheritance tax payable. It's an exempt transfer when you pass on. So rather than £325,000 going and 40% above that, no inheritance tax is charged. Your partner then has that interest in possession in the property. So they're allowed to live in it through their lifetime, not allowed to sell it. And then when your partner passes on to children, you look at the available nil rate bands at that point. Because you didn't use your nil rate band, I'm assuming all assets go to your spouse or civil partner, because you didn't use your nil rate band, that £325,000 is then available to your spouse or civil partner. In addition, you didn't use your main residence nil rate band, £175,000. Your partner gets access to that as well. So the bottom line is if you're married or in a civil partnership, with the same scenario, that spouse is able to leave up to £1 million to your children without paying any inheritance tax at all. Now, if that's not going to work for you, then do speak to us because we'll come up with the best plan that we can for you. But I would say there may be non-tax reasons why that wouldn't work for you, but I think you're going to get a far, far better outcome if there was a marriage or civil partnership there, Claire. I've tried to say that all as delicately as I can. Is there anything you would add to that story?
I wouldn't say in terms of tax, no. I think the only comment that I would add is that, so whilst arrangements can be made in a will to sort of secure that second person, be it a partner or be it a spouse, living in that property, I'd say it's just really important that you have that conversation with your children, really before your death, and just make them understand and verbalise what your wishes are in that respect, so that perhaps there are no surprises.
Yeah, thanks, Claire. Actually, that's a great trailer. Later in the year, we're going to do a webinar, which is about passing on wealth to the next generation and how you actually have those conversations with your children. So thank you, Claire.
So the next one, if I have just sold a property that is not my family home and pay capital gains on it, and then put the balance of the sale into a bank account, what happens if I die within a short space of time? Since doing so will add to the value of my estate and all the other assets are calculated for IHT purposes, this in effect will be a double taxation scenario. And are there any reliefs available?
This is absolutely a classic tax double whammy that we honestly see in real life. Yes, you're not going to get any relief for this, unfortunately. So you're going to pay perhaps 28% on the capital gains, and unfortunately, perhaps 40% on the value that you've realised from that property as well. So it's a really, really big tax hit for you. I'm trying to put this delicately. If you feel that maybe you're going to, if you feel you're going to be maybe paying inheritance tax quite soon, you might want to think about, well, actually, is it better to continue to hold a property in the estate so that you don't expose yourself to that double whammy? Bottom line, I think, look at your circumstances, speak to the professionals, and just go into this with your eyes fully open as to the possibility that there may be that double whammy. The UK tax system is confiscatory. You do need to speak to professionals to help you navigate your way through that. Anything else you would say, Claire, on that one?
No, not at all. Yeah, I think you've covered that well. I'm just having a look through. We've got lots and lots of questions coming through, so I don't think we're going to be able to get through all of them. But there are quite a few questions around, I guess, the subject matter today in that gifting property, and lots of variables in terms of whether that property is in the UK or outside of the UK. So I think it's just important to mention that you absolutely, can gift property. And if we're talking about a property where you're not going to live in it, you haven't got any ongoing enjoyment of that property, then it is going to fall under the potentially exempt transfer rules. We do need to consider capital gains tax. In the lot of scenarios that I've seen with these questions, it's in reference to perhaps a UK property being gifted by a non-UK resident. Now, one of the comments I would say about that is that certainly when we're giving advice to people returning back to live in the UK, whilst inheritance taxes is based on domicile, that might not have been affected with you being outside of the UK, it doesn't mean that being non-UK resident is not a good time to plan for IHT. Because of the different ways that capital gains tax is calculated for a non-resident as opposed to a UK resident, there can actually be advantages to you IHT planning as a non-UK resident, really to get those capital gains tax benefits in respect of UK property. So not a specific question there, but I hope that I've answered sort of a few various questions about gifting property.
What I would add to that actually is one of the considerations around this is I see many families and their funding for their retirement is going to come from buy-to-let properties and the income that's generated. So you have this tension between having a property in your estate, which is giving you a charge to inheritance tax, and getting income from it. So if you actually gift the property, you need to be absolutely sure that you can do without the income that's being generated from that property. That may be one of the important considerations around how do you fund your retirement living costs. And actually, if you need the income, you want to gift it away to get the value out of your estate, but you need the income, maybe it might be better to actually sell the property and invest in something that comes with an inheritance tax advantage that you might be able to take an income from. There are some very specific trust planning ideas around this that might just help you with that, just as an alternative option.
Yeah, great, Peter. So one question I think is picked up on something that's been said today with property, and I think gift with reservation of benefit. If I move back with my children after 10 years of the gift, so I'm going to assume that the property's been gifted that the children are then living in, does the reserved benefit still apply, and will I have to pay market rent to them?
Likely, yes. There are one or two circumstances where this may not actually apply. So perhaps in the very sad circumstance where perhaps you fall gravely ill, for example, and you move back into the property that you've gifted to your children, if the circumstances are right, there can be an exemption from those gift with reservation of benefit rules in that circumstance. But generally, you're going to end up paying a market rent to actually stay in that property that you've gifted with to your children. There is actually an annual de minimis limit, and I'm not sure I can say this the right way around. I always get this muddled in my head. Now, Claire will correct me because I know she's great at this. If your children aren't in the property, you're allowed to stay 2 weeks. And if your children are in the property when you're there, you're allowed to stay, well, in HM Revenue's guidance, it's a month, but we would say 4 weeks. So there is this little de minimis limit. You're not absolutely prevented from going and staying with your children, but there is a limit to how much time you can stay if you're just visiting casually rather than moving in. Claire, any other points you would pick up on that?
I think the only thing that I would add, and actually I read this, I found this quite interesting in an article the other day, that when we're looking at gifting and gift with reservation of benefit, there's sort of an idea or myth, if you like, that actually you just can't benefit within the 7 years or after gifting. And I think that the 7 years is really valid for a potentially exempt transfer, but it's just important to note really that you could pick up that benefit at any time period, and it could therefore come back into charge, or could end up being another potentially exempt transfer out of your death, out of your estate. So just be really aware of the rules.
Okay.
I think so. There's one question here which I think quite sort of has a good illustration for joint gifting. So can you gift jointly owned assets? And if so, what happens in IHT terms if just one of the owners die?
Okay. Do you want to pick that one up, Claire?
Yeah, certainly. So what I would say is that individuals are really their own persons for tax purposes. So we see lots of things where exemptions apply between spouses and civil partners. But what we would look at that in that situation is if you were, for example, each to a gift an asset or cash that's sort of worth £500,000, and one individual died, say 3 years later, we would just be looking at the gifts that they had personally made in the 7 years before their death. We wouldn't sort of be joining those up necessarily.
Thanks, Claire. I just needed to blow my nose. Apologies.
Oh, that's okay. No problem. So a lot of questions as well, actually, around the non-dom spouse election, which I think is a really interesting one. I think it solves a lot of problems. It's just worth really noting and reiterating, this is for inheritance tax purposes only. If you are not UK domiciled and you're currently sort of benefiting from using the remittance basis before the point that you become deemed UK domiciled, if you need to make that spousal election for inheritance tax purposes, it's not going to take away that ability for you to do that.
Yeah, I think one of the most common questions I have around this is, well, I don't want to move to the UK to make the election. You don't have to be in the UK to make the election either. And yeah, capital gains tax, income tax, no effect. It's only for inheritance tax.
Yeah. So I think the last sort of general theme before we wrap things up, Peter, as I know is a subject that we do advise on, is that giving away an asset or cash, someone sadly does pass away within the 7 years before that sort of has become the potentially exempt transfer has worked, if you like, and us looking at ensuring that liability. That's a really common scenario that we see that can provide protection. Would you have anything more to sort of talk around or add to that, Peter?
Yeah, so I think it's actually a great plan, because if you're giving a property, it's quite binary, isn't it? It's quite a lumpy asset for you. So the inheritance tax is likely to be very significant. But you know that if you make sure you don't retain any kind of beneficial interest in the property, you've got a 7-year timeline to get that out of your estate. So you'd want to speak to a financial planner and they would give you the advice on insurance. I don't advise on insurance, but what I would say is, anecdotally, I think you would find that just taking a term insurance policy for that 7-year term, and because it's on a decreasing basis, because the amount of the inheritance tax reduces over that 7 years, it could be a very, very cost-effective way to manage the risk. And you'd want that insurance policy, what we call written in trust, because what you don't want to happen is that insurance gets paid out and gets paid into somebody's estate, for example, if they pass away. So speak to a financial planner. It's a great use of insurance, I feel, for actually managing inheritance tax.
Yeah, absolutely. Thanks, Peter. I think we'll leave it there then. just want to say a big thank you for everyone's questions. I think we've had sort of near 70 questions this morning whilst we've been on this webinar. And that really is, you know, a great result for us. We're really pleased with that. So our apologies if we haven't been able to get round to them all. So if today was your first interaction with the FRI group, just a little bit of information around us. So we have 8 dedicated offices around the globe giving financial advice, tax advice, and working with sort of estates and trustees as well. And really the aim for us as advisors is to help give financial freedom, help assist you get financial freedom and work with you. So if you would like to discuss anything you've heard today, or perhaps you've got another need, please do get in contact with one of our offices, or perhaps indicate on the feedback form, which I think is going to come around shortly, that you would like some contact from someone. So I think ultimately that just leaves us to say, you know, thank you. Thank you for tuning in today and spending some of your day with us. I hope you found it interesting, informative, and yeah, have great days, everyone.
Bye. Thank you.
Bye. Bye.